Hello everyone, my name is Jonathan Lear and I'm a tax supervisor at Lear Pannepacker. I specialize in working with both individuals and not-for-profit organizations. And one of the biggest complaints I've heard between these two parties is that with the implementation of the Tax Cuts and Jobs Act of 2018, there's been a great reduction in the amount of taxpayers eligible to itemize their deductions. We're going to highlight a few different tax strategies that can not only minimize your tax obligation, but also maximize your charitable contribution to these organizations like Jewish Family and Children's Services. The first strategy we're going to talk about is donating appreciated securities. An appreciated security may be a mutual fund, ETF, stock, or a fixed income instrument that has appreciated in value. For example, let's say 5 years ago you bought a stock that was worth $5,000 and today it has now appreciated to $10,000. If you were to make that donation to the charitable organization, you would not only avoid paying capital gains tax on the appreciation of the $5,000, but if you also are eligible to itemize your deductions, you'd also be able to claim it as an itemized deduction for the fair market value of the stock at $10,000. The second strategy we're going to talk about today is setting up a donor-advised fund. A donor-advised fund is a fund that you can contribute to with cash or donated securities, whereas a professional organization such as Princeton Area Community Foundation or the Jewish Communal Fund will then manage for you. The advantage to a donor-advised fund is being able to lump all your contributions in the first year and receive the tax benefit. So for example, let's say you're typically the taxpayer that will give out $2,000 over a 10-year period every single year. Rather than giving out $2,000 every single year, what you can do is you can make a one-time lump contribution of $20,000 in year one, which will likely push you into the bracket to itemize your deductions. The third strategy is utilizing a qualified charitable distribution. A qualified charitable distribution is when you have a direct transfer from your IRA to the charitable organization. The biggest benefit in doing this is that any money that's directly transferred over to the charitable organization is excluded from taxable income. For example, let's say your taxable income is $100,000, including the distribution you took out from your IRA. Rather than taking out the distribution from your IRA to you directly, let's say you now give it to the charitable organization in the amount of $10,000. Your taxable income will now be $90,000. This is a really great strategy for people that don't itemize, because it can still be utilized whether you itemize or you use the standard deduction. I encourage you to talk with one of your accountants to see if these strategies may work for you, while also supporting the great organizations like Jewish Family and Children's Services.